Hello students, in this video we'll talk about what is depreciation and why there is a need of accounting of depreciation and how we can calculate depreciation. So first of all, before moving into depreciation discussion, first understand is that depreciation will charge depreciation against a non-current asset, and specifically I'm talking about the tangible non-current asset. So when you talk about tangible non-current asset, you can think of the buildings, the plant, machinery, fixtures and fittings, etc., etc. So these are the assets which are subject to the depreciation, the annual depreciation. So first of all, when we purchased any non-current asset, we record an accounting entry as the asset side. We debit asset side, record it asset on the debit side. So asset account is debited and the payment, if it has been made, then bank account is credited. If payment is not yet been made, then we can book a payable against it. Now we have to transfer this asset into the statement of financial position, and as we consume this asset, then this asset is subject to reduction in value, and this asset is subject to depreciation. There is a matching concept that the benefits of the assets and the consumption of the asset must be matched together in the same accounting period. Now, what exactly is the definition of depreciation? So, depreciation is systematic allocation of the depreciable amount of an asset over its expected useful life. So in this definition, what is depreciation? Is the systematic allocation of what? The depreciable amount over the expected useful life. There are three elements in this definition. One is the depreciable amount. You have to depreciate the depreciable amount, not the full value of the asset. So what is depreciable amount? Depreciable amount is the original cost of the asset minus the scrap value or the salvage value or the residual value. So if there is any salvage value, then deduct this from the cost, you will get the depreciable amount. For example, if my asset cost is 1000 and 100 is the scrap value, then this 900 is subject to depreciation, not 1000. Now after the depreciable amount is to be spread on the expected useful life. The useful life is always expected. The expected useful life means the period in which you will get the economic benefit. The benefit will be received. So say suppose you estimate the life and you say that the life is estimated to be 10 years at the time of initial recognition, then you have to spread this 900 depreciable amount over 10 years. But how we can do that? So that we needs a method. This is called the systematic allocation. Now, the accounting standards that deals with this depreciation will tell us that which method is to be used. So this refers to method of charging depreciation. Method normally depends on how you are deriving the benefits from the asset. So technically speaking, or typically, following methods are used to charge depreciation in each reporting period. Common method I'm using here. So two methods are quite common. One is called the straight line method of depreciation, and another is the reducing balance method or declining balance method, diminishing balance method. These are the common depreciation methods. So what exactly is a straight line method of depreciation, and how we'll record depreciation under straight line method? So under straight line method, either you can calculate through a percentage if it is given, or through useful life. Whatever is the given, in straight line there will be a constant depreciation each year until and unless the estimates are being changed. So for example, let's assume that the cost of the asset is 1000, the scrap is 100, and life is 10 years estimated. This scrap value is also estimated. So under straight line, the depreciation is to be calculated as cost minus scrap, that is the depreciable amount, divided by the expected useful life. You will get per annum depreciation, and that will remain constant throughout the life. So it's 10, it's 90 per annum. So this is annual depreciation. If estimates will remain the same, then we will recognize 90 per annum as depreciation expense. Depreciation is expense normally, so it is to be accounted for as depreciation expense debit in profit and loss account, 90, and we have to credit asset, but instead of asset we will credit allowance for depreciation, which is the contra asset, 90 credit. This allowance for depreciation then reduce my asset value in the balance sheet. So this is first year allowance for depreciation. This is 90. So in the financial statement, my value is 910, and this is called the book value at the end of year one. Now, as it is a straight line method of depreciation, so the next year would be the same in the third, fourth, and fifth, so and so on. The depreciation will remain the same. So under the straight line method, you have to use this formula. And if percentage of depreciation is given, then instead of formula, direct apply the percentage and you will get the same figure. Now let's talk about the second method, that is the reducing balance method of depreciation. Under this method, the depreciation will be higher in initial years. In initial years, we'll charge higher depreciation, and in subsequent years, depreciation will be reduced gradually. So this method is applicable on those assets which provide economic benefit initially higher and subsequently lower. And in this particular method, each year depreciation value will be different. So in year one, we will apply depreciation on cost multiplied by percentage of depreciation. You will be provided with the rate of depreciation of percentage of depreciation, and as a result you can calculate year 1 depreciation. But in year 2, now the depreciation would be applicable on the book value, that is net book value. The percentage will remain the same, but depreciation would be charged against the net book value, that is cost minus depreciation. How we can calculate the net book value? It is the cost minus allowance for depreciation. And in each year, first we will identify the net book value for that year, and then we'll calculate the value of depreciation. So for example, let's assume that the cost is 500, rate of depreciation is 20%, reducing balance, and scrap is 50. Calculate depreciation for first 2 years. Now year 1, the cost is 500, multiply by rate of depreciation, so the depreciation is 100. Now in year 2, first identify the net book value, that is original cost 500 minus depreciation, multiply by now 20%, so that will give you a figure of 80. So after second year, the net book value after second year is 500 minus first year depreciation minus second year depreciation. So my net book value is 320 at the end of year 2. And if you have to find out this directly, then you can identify the net book value as 500 original cost, multiply by if depreciation is 20%, the remaining value is 80%, and 80%. So in this way, this is 320 directly the net book value. Similarly, if you have to identify the net book value at the end of year 3, so multiply 0.8, 0.8, 0.8, you will get the net book value. So as far as the presentation is concerned, depreciation would be part of profit and loss account as an expense. It might be in the cost of goods sold, or it might be in the admin or distribution expense. And in balance sheet, we will record cost minus the allowance for depreciation, that is the net book value.